Here we're comparing financial statements, specifically the balance sheet and the income statement, to determine what the differences are between them. The differences can essentially be broken down into these statements: timing, performance evaluation, reporting, usage, and credit. So let's start with timing. So with the balance sheet, this is showing information for a specific moment in time, whereas the income statement is for a period in time. If we were to look at performance with the balance sheet, this actually doesn't show us performance at all. It really just shows us, we'll drop down to reporting here. What the balance sheet shows us is assets, liabilities, and equity. Now these assets, liabilities, and equity are very important. However, they don't explain the performance of this firm. And that's where the income statement comes in handy. This income statement does tell us about performance because it reports revenues and expenses, which explains to us how the company is doing monetarily. So it's telling us what the firm is earning, right, in revenues and their expenses. That way we can determine if one outweighs the other and at which rate they may be increasing or decreasing. That'll give us a really good idea of where the firm is at financially. Now, the usage of these, when it comes to the balance sheet, this is really just allowing firms to determine whether or not they can meet their financial obligations. So with the understanding that they have so many assets and so many liabilities, well, are their liabilities feasible? Can they actually pay those back? Are they able to? And that's going to be determined based upon what they have in assets and liability. Now, when it comes to the income statement, this is going to be used to, like we said before, it's to evaluate performance. We're able to see over a period of time how this firm has performed in its sales, in its revenues, its profits, its expenses, its rate of increasing and decreasing, marginal costs, marginal benefits, all of that we can kind of grasp from this income statement, which boils down to an evaluation of its performance. And then we see this credit, which kind of leads into everything that we just talked about for each of these, right? With the balance sheet, the creditors may use this to determine whether or not they can extend any more credit to the company, right? Because if they look at their balance sheet and they see that their liabilities are way outweighing their assets, they're probably not going to lend them any more credit, right? That's the same thing for us. Creditors, they oftentimes look at your debt to income ratio for us as individuals, right? Well, the balance sheet kind of tells something similar, but for firms. Now, the income statement, this is just going to suggest to creditors whether or not the company can actually pay its liabilities. And while liabilities are included on our balance sheet, the income statement tells us exactly how much the company is actually making. So if they're not making a whole lot, we'll know in this case on our income statement based upon their revenues, and we'll be able to determine whether or not they can actually afford to pay back these liabilities.